You've probably heard the term Fed pivot thrown around in the news, but what does it really mean when the Federal Reserve suddenly slams on the economy's brakes or floors the gas pedal? Well, today, we're going to break it all down.
And if you've ever wondered what it means for the markets, the economy, or, your own wallet, then you've definitely come to the right place.
So here's our game plan. We'll start with what a pivot actually is. Then we'll get into the Fed's two main speeds. We'll look at some real-world pivots from recent history, and finally, we'll connect it all back to the big picture, what it means for you.
All right, first things first, what exactly are we talking about when we say the Federal Reserve pivots?
Okay, in the simplest terms, a Fed pivot is just a massive U-turn. It's when the U.S. central bank completely reverses its strategy, usually because the whole economic landscape has just fundamentally changed.
I love this way of thinking about it. Imagine the Fed is driving the economy's car. Now, a pivot isn't some gentle turn or a simple lane change. Nope, it is a sudden, sharp, pull-the-wheel-hard U-turn, because the road ahead looks totally different than it did just a second ago.
And to really get that U-turn, we need to understand the car itself. The Fed basically operates at two speeds. It's got a gas pedal to speed things up, and it's got a brake to slow things down.
You see, the Fed's whole job is this constant balancing act. They're juggling two big goals, what's known as their dual mandate. One, keep prices stable, that's all about controlling inflation. And two, make sure as many people as possible have jobs. And believe me, those two goals are often pulling in opposite directions.
And this slide really gets to the heart of their toolkit. If the economy is slowing down and unemployment is ticking up, they hit the gas. That's called an expansionary policy, and they do it by lowering interest rates. But if the economy is running too hot and inflation is soaring, they slam on the brakes. That's a contractionary policy, and it means raising interest rates. A pivot? It's simply a hard switch from one of these to the other.
So this isn't just some abstract theory, right? The Fed has actually made these dramatic U-turns several times in recent memory. Let's take a look at when, and more importantly, why.
This timeline is pretty incredible. You can see a clear pattern. Pivots are almost always sparked by a major crisis. The dot-com bubble bursts, they pivot from hiking rates to slashing them. The whole financial system nearly collapses in 2008, they pivot again, cutting rates to practically zero. The world shuts down for a pandemic, another instant pivot. And then, when inflation came roaring back, they pivoted yet again, hiking rates like crazy. Every single crisis forced a complete change of direction.
And here's a great little pro tip from the source material for anyone who likes to look at charts. These pivots aren't hiding. You can actually see them. They show up as these super sharp peaks and deep valleys on a chart of the federal funds rate. That's the key interest rate the Fed controls.
Now, when you see all these pivots happening in response to a crisis, it naturally leads to a huge debate. Is the Fed steering the car, or are they just reacting to the crash?
Which brings us to a really central question for pretty much everyone, from investors to economists. Do these pivots always work? I mean, is it always the right move at the right time, or can they sometimes just get it wrong?
Well, there are two big criticisms. The first is about timing. A lot of people argue that the Fed often acts too late, that they only pivot once the crisis is already underway. The second is about duration. Sometimes they just don't stick with the new policy long enough. The classic example is from the 1970s, when they gave up on fighting inflation too soon, and we ended up with this awful combination of a stagnant economy and high prices, also known as stagflation.
So if these moves have such a massive impact on literally everything, it just begs the question, can we see them coming? Are these pivots predictable?
Well, it's tricky. On one hand, the Fed has tried to be a lot more transparent lately, often dropping hints about what it's thinking. But even with all that, nailing the exact timing of a pivot is still really a game of educated guesswork. You can look at market tools that show you probabilities, but they're never certainties. And it's that gap between what's probable and what's certain that can cause such huge swings in the market when the Fed finally does something unexpected.
All right, let's bring this all home and focus on the bottom line. Why should any of this really matter to you?
Here is the most important thing to remember. A Fed pivot is not just some boring technical adjustment. Think of it more like a giant flashing neon sign telling the world that the basic rules of the economic game have just changed in a big way.
And this is exactly why it matters to you personally. That U-turn the Fed makes has a direct ripple effect right into your life. When the Fed pivots, it changes the interest rates you pay on your mortgage, your credit cards, your car loan. It also changes how much interest you can earn on your savings, and it can even affect the health of the entire job market.
So we'll leave you with this final thought. The economy is always in motion, and if history has taught us anything, it's that big shifts are going to happen. Which means the real question isn't if the Fed will pivot again, the question is when, and what crisis will be the one to trigger it. But now we don't know exactly what to look for.